I want to welcome you guys to a complete, comprehensive guide to dividend investing. If you are seeking a reliable strategy to generate income and grow your wealth, dividend investing can be quite a powerful tool in your financial arsenal. Now, by investing into dividend-paying stocks, you can benefit from regular cash payments, while potentially participating in the company's growth as well. Dividend investing offers the best of both worlds, income and growth. And while traditional investment strategies focus solely on capital appreciation and then withdrawing the money slowly throughout retirement, dividend investing allows you to generate a steady stream of income from your investments. And whether you are a seasoned investor or a newcomer to the world of finance and investing, this step-by-step guide will equip you with some of the basic knowledge and tools to succeed in dividend investing. Now a little bit about myself. I'm personally a 7-figure investor and bought my very first dividend stock ever around 7 years ago. And years before I even bought my very first dividend stock, I remember being very interested in the idea of dividend investing, but found myself not knowing where to start and asking myself simple but yet important questions like, what even is a dividend? Why do stocks pay dividends? How often do these so-called dividends get paid out? And how can I get my hands on some of these dividend payments? Now, if you are finding yourself asking some of these questions, or maybe all of them, and want to know pretty much all there is to know, or at least the basics about dividend investing and how it works, well then keep watching. And for those interested in seeing my actual dividend portfolios live on this video, stay tuned until the end of this video because we are going to go over my exact real holdings in one of my largest dividend portfolios, which is currently valued at around $500,000. And on top of that, I'm going to show you exactly how much this portfolio generates in dividend income for me on a monthly basis. So let's start from the beginning. What actually is a dividend? So a dividend is a distribution of a portion of a company's earnings or profits to its shareholders. When a company generates profits, it has several options on how to utilize these funds. One option is to reinvest the profits back into the business for expansion, research and development, or debt reduction. Now, another option that the company has is to distribute a portion of these profits to the shareholders in the form of dividends. Dividends are typically paid out in cash, but can also be paid in additional shares of stock or other assets on top of that. Cash dividends are the most common form and are usually distributed on a regular basis. Most companies pay dividends on a quarterly basis. Many companies also pay a monthly dividend, but some companies pay a dividend semi-annually or even once a year. The amount of these dividends is going to be determined on the company's board of directors, and it's based on various factors including the company's profitability, the company's financial health, growth prospects, and cash flow. When a company declares a dividend, it announces the amount to be paid per share of stock and sets a dividend payment date. The dividend payment date is the day when the dividend is actually distributed to the shareholders of record. Now, one question I had at the beginning of my dividend investing journey is, when do I have to invest into a stock in order to receive the next dividend? So to be eligible to receive the forward dividend payments, an investor must own the stock on the record date, which is typically a few days before the payment date, and some companies have a bigger or lesser gap. The record date is determined by the company and often disclosed in advance. So if you want to be eligible to receive a dividend from a company, make sure you own shares of whatever stock or ETF it is on or before that date. Dividends are often expressed as a dividend yield, and this is something else that really confused me at the start of my investing journey. The dividend yield is the annual dividend payment per share divided by the stock price. So for example, let's use a really easy example. Let's say a company pays an annual dividend of $2 per share and the stock price is $50. The dividend yield would be 4%, or $2 divided by the $50. Dividend yield is an important metric for income investors, as it definitely helps assess the income potential of a stock relative to its price. And as you get more and more involved into your dividend investing journey, you're going to find yourself looking at stocks and ETFs, and a lot of times the first thing you're going to want to know is, how much does X, Y, or Z stock yield? Because you're of course going to want to know how much you're going to make off your investment. Dividends are considered a return on investment for shareholders. They provide investors with a way to benefit from the company's profitability and share in its success. Dividend-paying stocks are often favored by income-oriented investors who seek a regular income stream from their investments. It is important to note that not all companies pay dividends. Some companies, especially younger or high-growth companies, may choose to reinvest most of their profits entirely back into the business to fuel expansion and innovation. So keep in mind, it's important to note that not every single company in the stock market and not every single ETF does offer a dividend, but there are quite a few that do. Therefore, investors interested in dividends need to specifically seek out dividend-paying stocks. Dividend investing can offer several advantages, and some of these advantages are a steady income stream, which can be particularly attractive for older investors closer to retirement, or individuals seeking regular cash flow. Dividends can also contribute to an overall return on investment, as they can enhance the total returns of the stock through both income and capital appreciation. Now, what I mean by that is, let's say you invested into a dividend stock that was $100 per share when you bought it. By the end of year one of you holding onto this stock, let's say the stock went up $10, but also paid $5 per year in dividends. You would now not only be looking at the $10 increase as a capital appreciation on your investment, but also the $5 dividends. So in total, you would have a $15 total return on your investment after year one. Now, additionally, dividends can provide a degree of stability and reliability, as companies that consistently pay dividends are often financially sound and well established. You're going to find that a lot of companies, especially companies that have a long-term track record of paying dividends, companies like Coca-Cola, like McDonald's, just to name a few. Companies like this are, for the most part, very large and, generally speaking, financially sound and definitely well established. So now that we went over some of the basics of what a dividend is, let's talk about some of the things to be aware of when it comes to dividend investing. And one of the most important things, in my opinion, to be aware of is chasing high-yielding dividend stocks. Now, certain stocks and ETFs out there are going to offer a very high starting yield. And when investing into these high-yielding dividend stocks or ETFs, there are several factors to be aware of to make sure that you're making an informed investment decision. And while high-yielding dividends may seem attractive, especially to newer investors, and let me tell you, when I first got started, I was investing into high-yielding dividends like crazy because I figured, why not? They're offering way higher yield, which means, in theory, you're going to get paid more per year. But that's not always the case. Let's go through a few of the reasons on why high-yielding dividend stocks or ETFs can be dangerous. So first, some of these high yielders can have an unsustainable dividend. It's important to be cautious of companies offering exceptional high yields that seem too good to be true. Dividend investing is pretty much like anything else in life. If it seems too good to be true, it probably is. A significantly higher yield compared to the industry standard may indicate an unsustainable dividend payouts. So even if a company is paying out a massive yield, let's say a 10%, 12%, 15% dividend yield, it doesn't mean that it's going to stay forever. A company's ability to consistently generate sufficient earnings and cash flow to cover a dividend payment is what's crucial here. Examine the company's financial health, payout ratio, and dividend history to assess the sustainability of the dividend. And again, like anything, there can be outliers, but that's something to take seriously. Also, when it comes to high-yielding dividend stocks, you could see dividend cuts in the future. High-yielding dividend stocks can be vulnerable to dividend cuts. Companies may reduce or even eliminate dividend payments due to financial difficulties, changing business conditions, or the need to reinvest the profits for growth. Generally speaking, most of the time, when companies are offering a very high yield, they could be at risk, or at least more at risk, of dividend cuts in the future. And let me tell you, there's nothing more unfortunate than when a company is paying out a nice big dividend and all of a sudden you get news that the dividend has been reduced by half or even suspended all the way. Now, high-yielding dividend stocks often also come with higher risk because the market may view these stocks as a riskier investment, causing their stock price to decline and decay over time. Companies with high dividend yields may be in sectors facing challenges. They may be companies with higher debt levels or operate in volatile industries. Some higher-yielding stocks or ETFs may offer limited growth potential. Companies with higher dividend payouts may allocate less capital towards growth initiatives or reinvest in the business. So companies that have higher yields, they might be paying out the majority of profits or even taking out debt to pay their shareholders dividends. Now, this is most likely not going to be something that you're going to want to be invested in long term. Like I said earlier, it might be fun and it might be exciting to receive a large dividend payment from a high-yielding dividend stock or ETF, but keep in mind there's many risks involved. So now that we went over the basics of what a dividend is and what maybe to look out for when it comes to higher yielding dividend stocks and ETFs, let's talk about the differences between investing into growth stocks and dividend stocks, because this is also very important to know if you're a newer investor. Investing into growth stocks and dividend stocks represent two distinct approaches to investing, each with its own characteristics and objectives. Let's go over some key differences between the both of them. So as far as growth stock investing, growth stocks are primarily focused on capital appreciation and the potential for substantial growth in the company's earnings and stock price. These companies typically reinvest their profits back into the business to fund expansion, research, development, and other growth initiatives. So think of a company like Amazon. Amazon is most focused on growth and making the company bigger and bigger, bringing in more and more year-over-year revenue and reinvesting all the potential revenue and profits in order to make the company and the stock price grow long-term into the future. Now with growth stocks, you're not often going to find that they pay a dividend, or in some cases they may pay a very low dividend. For example, there's some companies, some stocks in the tech sector that do pay a dividend, but it's maybe under 1%, something like Apple. So instead of paying a dividend, these companies, these growth stocks, choose to reinvest their earnings for future growth potentials. Again, their focus is growing the share price of the stock. Now with growth stocks, it's important to note that there's likely going to be more volatility. Growth stocks tend to be more volatile and experience larger price swings compared to dividend stocks. Their share price are driven by market sentiment, investor expectations, and the company's growth prospects. This volatility can present both opportunities and risks for investors. Now, this was the main reason why I was more driven to dividend investing from the start. I would consider myself more of a conservative investor. I'm not looking to get rich overnight or even in a few years. I'd much rather find an investment vehicle or strategy which can offer me great wealth long-term into the future. That's why dividend investing was better for me. Investing in growth stocks carries a higher level of risk. Companies in the growth phase may be subject to market uncertainties, increasing competition, technological disruptions, or changes in consumer preferences. The potential for high growth can also attract speculative investors, leading to increased volatility. And lastly, when it comes to investing into growth stocks, valuation is important. Growth stocks are often valued on their future earning potential rather than their current earnings. Investors analyze metrics such as price to earnings or PE ratios, price to sales or PS ratios, or other valuation measures to assess their attractiveness relative to their growth prospects. So now going over some of the characteristics that make up dividend stocks. Dividend stocks prioritize generating a steady stream of income for investors. These companies typically have a history of consistent earnings and choose to distribute a portion of their profits to shareholders in the form of dividends. Dividend stocks are often sought after by income-oriented investors who are much less concerned with the long-term capital appreciation like you would find in growth stock investors. Dividend investing often offers more stability and less volatility compared to something like growth stocks. And this is because companies that consistently pay dividends tend to have a more established business model, stable cash flows, and strong financial positions that investors can sort of count on, which makes investing in dividend stocks much less stressful in my experience. Also, with dividend stock investing, there's more of a long-term approach. Investors focus on sustainability and growth potential of the dividend payments over time, rather than the short-term price fluctuations, which also, in my experience, makes dividend investing much less work compared to growth stock investing. Now, when it comes to valuation for dividend stocks can sometimes be valued based on their dividend yield, which represents the dividend payments as a percentage of the stock price. Investors compare the dividend yield of a stock and other income-generating instruments to assess its attractiveness. A higher dividend yield may indicate a higher income potential relative to the stock price, but also remember, higher dividend yield doesn't always mean it's a better investment. So now that we have some of the basics down, let's go to one of my favorite websites and show you how I personally enjoy researching different dividend stocks to figure out which investment is right for me. So right here we are on seekingalpha.com, and I'm not sponsored by them or anything, but I do enjoy this website. There's plenty of different other research websites out there, but Seeking Alpha is pretty decent. I think there is a paid version of seekingalpha.com, but I just have the free version. So when it comes to seekingalpha.com, here's the home page right here. You can go up here and type in any stock with any ticker symbol and be able to research the company in some great detail. So for example, if we want to look into something like SCHD, the Schwab US Dividend Equity ETF, you click on it right here and it brings you to the summary of SCHD, where you can look at things like how the stock has done in the last day, the last month, all time, etc. You also can look at some pretty interesting metrics, like how the ETF or stock has performed over the last 52 weeks, how it's performed throughout the day, the ETF in this case expense ratio, which is how much the fund charges you to own it, the dividend frequency of whatever instrument you're looking at, the dividend rate, which is how much the stock or ETF pays out on a yearly basis, the AUM or assets under management, which is how much money is in the fund, and of course the trading volume. So from here on seekingalpha.com, once you're in on whatever stock or ETF you want to look into, you can go to things like holdings and see the exact breakdown of whatever you're looking at. So once again, for this example, for SCHD, you can see the breakdown of all the different sectors on a percentage basis to really get an idea of what you're investing into. You can also see things like the top 10 holdings. So in this case, these are SCHD ETF's top 10 holdings. And once again, what percentage of holdings they are in relative to the fund. Now, one of my favorite tabs when it comes to doing research for dividend stocks and ETFs on seekingalpha.com is this right here, the dividends tab. So if you click right here on dividends, you can see right here all the information you're going to need to know when it comes to investing into ETFs or stocks, of course. At the top, you can see right here, it shows you the dividend yield, the trailing 12 months, which is the sum of actual ordinary cash dividend payments in the last 12 months. And then of course you have dividend growth rate, which is how fast the stock or ETF raises their dividend over time. You have the 3-year growth rate, 5-year, 10-year. You have the amount of years of consecutive dividend growth and the consecutive years of dividend payments. If you scroll down, then you can see the dividend summary. So down here, it shows you the trailing 12-month dividend yield. It shows you the annual payout amount. It shows you the payout ratio if there is one. It shows you the 5-year growth rate, dividend growth rate. And then it shows the last announced dividend right here, the ex-dividend date, which is important because you need to know these dates to know when you are going to need to own the shares of whatever stock or ETF you're looking to buy into to get the next dividend. You have the payout date, the record date, the declaration date, and the dividend frequency. If you scroll back up to the top, you can go through here and see things like dividend history, where it will show you how many years in a row that a stock or ETF has paid their dividend, how much they paid every single quarter or month, etc. And if you keep scrolling down, you can see the entire dividend payment history for whatever stock or ETF you want to look at. Now, one of my other favorite tabs when it comes to seekingalpha.com, and one that I use quite a bit, is right here. It's called charting. So this is pretty cool because you can chart out different stocks and ETFs against each other. And you can use different metrics like price return, total revenue, EBITDA, and all kinds of other metrics. So if you were to look at total return, for example, which is the share price plus the dividend included, and stack up SCHD or other names next to the S&P 500, you can see which has done better over the last 1 year, 3 years, 5 years, 6 months, etc. This gives you a really good idea and a really nice visualization, pretty simply, to see how good X, Y, or Z investment has done compared to the general market. So now that you understand the basics for Seeking Alpha, and again, you don't need to use seekingalpha.com, that's just my specific favorite dividend investing tool, but there's tons of others out there. Let's go over some common dividend investing questions and see if I can answer some of them. So one of the common questions is, how do I find dividend paying stocks? So there are really several ways to find dividend paying stocks. You can start by researching companies in different sectors that are known for paying dividends, such as utilities, consumer goods, or real estate investment trusts known as REITs. Financial websites like Seeking Alpha, MarketWatch, there's tons of them out there. They can help you because the more you're on them, the more you kind of just click around and get lost in it, the more you're going to uncover. It does take time, but it's not all that difficult. Another good question is, what should I consider when selecting dividend stocks? So when selecting dividend stocks, some of the things that I consider are things like the company's dividend payment history, the company's financial health, how much the company's bringing in revenue per year, is the amount of revenue going up or down, how much of that revenue is profit, the company's payout ratio, industry outlook for the company, and of course things like competitive position. Is the company going to be here for a while? Do you think this stock is going to outlast you? Also things like track record of consistent dividend payments, sustainable dividend yields, and things like that. Another good question is, what is diversification and should I use it in my portfolio? So diversification is having different investments throughout the market and not putting all your eggs in one basket. Diversification is definitely key to reducing risk in any investment portfolio. In dividend investing, though, you can diversify by investing into dividend-paying stocks from different sectors, industries, and even different geographical locations. Additionally, if you want to be very diversified, you can invest into things like exchange-traded funds or ETFs that have a diversified basket of different dividend stocks. Diversification is definitely key. It's once again not something that I really did enough of when I first started investing, but now, as you're going to see here in a few minutes, my portfolios are heavily diversified. Another good question is, can dividends be reinvested? So once you get paid the dividend from whatever company or ETF, can they be reinvested? And the answer is yes. Many companies offer dividend reinvestment programs. Certain brokerages offer them too, which basically allows you to automatically reinvest the dividends that are paid out by whatever company or ETF into additional shares of it. And this, of course, can help accelerate the growth of the investment portfolio very quickly. Another great question is, are dividend payments guaranteed? And this is important because dividends are not guaranteed. Companies can reduce or suspend dividend payments if they face financial challenges, or if companies decide to reinvest their earnings back into the business. It's important to assess a company's financial health and dividend sustainability before investing into a company for their dividend. And again, this part is going to take some practice and a lot of research. You're going to need to really try your best to decide which companies are going to have the safest dividend outlook and which companies are going to generate the largest total return. Another common question when it comes to dividend investing is, of course, taxes. So when it comes to taxes, this is going to be a case-by-case basis because everyone has a different situation. And I'm definitely not an accountant, but dividend income is generally taxable. The tax rate on dividends depends on factors like your income level, the type of dividend, whether it's a qualified or non-qualified dividend, and of course, different countries' tax laws. But please take the time to consult a tax professional or refer to tax guidelines to find specific information. So now that we went over some of the common questions when it comes to dividend investing, let's talk about some of the common mistakes that newer dividend investors often find themselves in. One of the most common mistakes that dividend investors find themselves in is chasing high dividend yields. Now, buying into a dividend stock or ETF, solely focusing on the highest dividend yield without considering things like underlying fundamentals of the company, extremely high yields, is definitely something a lot of newer investors do. And as we talked about earlier, extremely high dividend yields can be a clear warning sign of an unsustainable dividend, or simply put, most likely underlying issues with the company. Another common mistake that dividend investors make is ignoring dividend sustainability. Investing in dividend stocks without evaluating the company's ability to sustain or grow the dividend payments can be very, very risky. Analyze the company's earnings growth, the cash flow, payout ratio, and other metrics to figure out if a company does have or doesn't have a sustainable dividend ahead. Another common mistake is neglecting dividend growth. Overemphasizing the current yield and overlooking the potential for dividend growth in the future is a major, major mistake. Dividend growth is crucial for maintaining purchasing power over time, especially in the face of inflation. Looking for companies and ETFs that might not have the largest starting dividend yield, but can grow their dividends quickly and have over the long term is very important when getting started. Another mistake is lack of diversification. Failing to diversify dividend stock holdings can expose investors to undue risk. Concentrating investments in a single sector or putting all their money into a few individual stocks can increase vulnerability to industry-specific risks or adverse company-specific events. Diversity across different stocks and sectors can mitigate risks and protect your portfolio during downturns. A few more mistakes that investors typically make is focusing solely on dividends. While dividends are a key component to dividend investing, of course, it's important to consider things like overall investment thesis, beyond just the income generated from dividends. Evaluating the company's growth potential, competitive advantage, market position, and other things can be just, if not more important, than the dividend a company or ETF is currently offering. And lastly, one of the common mistakes is emotional decision making. Making investment decisions based on short-term market fluctuations or succumbing to emotional biases can hinder long-term success. Avoid reacting impulsively to temporary market downturns or chasing the latest market trends. Maintain a disciplined investment strategy, focus on company fundamentals, and have a long-term outlook. So next, what we are going to do is look through one of my largest dividend stock portfolios that's currently valued around $489,000. Now, this portfolio alone currently pays me around $2,100 estimated on a monthly basis. And just a side note, I do have different portfolios on different brokerages, just of course to stay under the SIPC insurance. Now, getting right into it, this portfolio has a mix of different stocks and ETFs, and some pay huge dividends on a monthly basis and some not so much. But to break things down, we first have 680 shares of JEPI, the JP Morgan Premium Income ETF. Now, these shares of JEPI are going to, of course, have an estimated annual income that's different on a monthly basis because JEPI doesn't pay the same dividend on a monthly basis. But as of right now, it shows that JEPI pays around $3,200 per year in this portfolio. The next biggest position, or the next biggest, annual payout is from my 918 shares of Realty Income, around $2,820 a year just from the Realty Income in this portfolio. Next, we got 1,000 shares of Verizon, which pay around $2,660 per year. Then we have 984 shares of QYLD, which pay around $2,000 per year. Then we have 1,100 shares of Devo that pay around $1,882 per year. 302 shares of JEPQ, which pay around $1,560 per year. We got 512 shares of BST, which pay around $1,536 per year. We have quite a bit of EPD, 561 shares that pay around $1,100 per year. Then we have 1,748 shares of BDJ, which pay around $1,100 per year. Then we have my biggest position across all my portfolios, which is my 1,000 shares of Apple, which pay around $960 per year. Next, we have XYLD, 194 shares, which pay around $848 per year. OHI Omega Healthcare pays around $800 per year. We have SCHD, my favorite dividend growth ETF, 186 shares in this portfolio, pay around $487 per year, more or less. Then Altria, 119 shares of Altria, which pay around $466 per year. JP Morgan, 100 shares, pay $420 per year. NUC, 246 shares, pay around $385 per year. Then we have TSLY, a little bit of TSLY, never heard anyone, 46 shares, pay around $364 per year. Then 419 shares of ETJ, pay around $273 per year. MPW, the 442 shares, pay around $265 per year. National Retail, 107 shares, pay around $241 per year. WP Carry, 48 shares, pay anywhere from around $200 per year. PNW, 47 shares, pay $165 per year. Main Street Capital, one of my favorite monthly payers, pays around $157 per year. 24 shares of UPS, $155 per year. 58 shares pay $132 per year. Vici, 77 shares pay $127 per year. Simon Property Group, 15 shares pay $114 per year. 81 shares of BOI pay around $111 per year. Then we got some SVOL, 29 shares pay around $109 per year. 50 shares of Walgreens are $96 per year. We got a little bit of B&Q, 26 shares pay $93 per year. Then we have some QQQX, 42 shares that pay $73 per year. Then we got SPYI, 12 shares pay around $69 per year. We have KMI, 59 shares that pay $66 per year. We got 22 shares of SDIV, pay $61 per year. We got 16 shares of Extra Storage, $39 per year. We got Pembina Pipeline, 20 shares, pay around $38 per year. Next, we got AMLP, 12 shares that pay around $38 per year. ABR, 18 shares that pay around $30 per year. We got T-Row, 6 shares that pay around $30 per year. DLR, we have 4 shares that pay around $20. And then we have a little bit of RYLD, APLY, HRZN, CEFT that pay around $10 or $15 per year. And then the final few names pay anywhere from around a few dollars per year because I just have a share or so of them. Now, as you see right here, this entire portfolio as of filming this is worth around, say, $504,000. But more importantly, maybe, it pays around $25,000 per year in dividends. Now, if you've made it to this point in the video so far, comment down below your favorite position of mine that I've went through so far. But without any further waiting, let's look at my other portfolio that I've never shown here on YouTube. So here it is. This is one of my other portfolios, and this is the estimated annual income. Right here in this tab, we have BDJ, we have $63 per year. BTI, a newer position that I started as of recently, $14.14 per year. We have more Devo, of course, $367 per year. We have EMB Enbridge, $76 per year. We have more EPD, $490 per year. Then we got a bunch of Main Street Capital, $345 per year. We got some Altria, $964 per year. Then we have a ton of national retail, $309 per year, and a ton more realty income, $3,305 per year. So that gives you a decent idea of what I hold in some of my larger dividend growth portfolios. And keep in mind, I will be sharing more of my other portfolios as time goes on here on my channel, so make sure to subscribe if you want to see under the hood and in a very transparent manner, show you exactly what I'm buying and selling on a consistent basis. I always found it fun to come on YouTube and see what other dividend growth investors had in their portfolio and how much they were getting paid on dividends on a consistent basis. Now let me be completely clear here. I'm not making this video to brag, of course. I know there's other investors right here on YouTube that would make both the portfolios I just went through look absolutely tiny, and my portfolio, of course, is bigger than some people's portfolio. But like I said, I find it fun to see other people's portfolios in a transparent manner like this on YouTube, and I hope you did as well. Of all these different holdings, you can sort of get an idea of where I'm kind of investing more and less into, and as time goes on and as I get a little bit older, I have been more and more interested in investing into some of the ETFs, like the SHD ETF, for example, or even things like Devo. But that being said, I'll always have other larger satellite positions like Realty Income, which I own a ton of. And with owning a ton of Realty Income, even though it is a single stock, by selling covered calls on it, I do limit some of the downside, but also have a limited upside potential. But for me, being more of a risk-averse, more conservative, sort of scaredy cat investor, it works out pretty good for me. Now, the last thing I'll mention is that I am planning on moving a lot of things around in this portfolio come very soon here. So if you want to stay up to date with all that, make sure to please drop a like down below and subscribe to see my next moves, because I promise you some of these moves might be shocking. All in all, if you had to pick one or two positions out of my entire portfolio and you could only hold on to those two stocks or ETFs forever, which would they be and why? Comment down below. If you enjoyed this video, make sure to please drop a like down below and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here. If you're currently in your 20s and looking to dip your toes into the world of investing, well then you found the perfect video. Investing in your 20s is a smart move, and because you're relatively young, focusing on more growth-oriented ETFs can be an excellent strategy. But especially a lot of newer investors don't know which ETFs they should consider. But in this video, we are going to go through one of my favorite growth-oriented ETFs that I think could be a potential perfect option for a young investor with a long time frame ahead of them. Now stick around because you are definitely going to want to learn more about this growth ETF as it's had massive returns so far. Now we're going to go through all this and more. Right after you, please drop a like in this video and subscribe for more future content like this. Now before we go into exactly which ETF I'm talking about and all the ETF has to offer, let's talk about why anyone at all should even start investing in their 20s. And the answer to this, simply put, is that time is on your side. When you start investing early, the younger the better. You have the advantage over older investors because you can work with the power of compound interest. This means that the money you invest has more time to grow, potentially turning even small contributions or deposits over time into significant wealth in the long term. Additionally, in your 20s, because you have such a long time frame ahead of you, you can afford to take a little bit higher risks. And because of this, you're able to weather market fluctuations and take advantage of higher risk, higher reward opportunities like the growth ETF we're going to go through. Now, the growth ETF that I think would be a perfect candidate for anyone in their investors to look into and possibly invest into is the Schwab US Large Cap Growth ETF, or SCHG. And in the last 14 years is up over 488%. Just year to date, this ETF is up over 36%. In the last 5 years, up over 88.65%. Now, SCHG is currently trading at $75.22 per share, which is pretty close to the 52-week range high. But for long-term investors, especially if you're in your 20s, it wouldn't really even necessarily matter all that much when you buy into an ETF like this, because as you can see, historically speaking, even after some pretty big drops, this ETF has pretty much always recovered and kept moving up and to the right. Now, before we go any further, let's dig a little bit deeper into the SCHG, the Schwab US Large Cap Growth ETF, learn more about it and see what it has to offer. So first, one thing that stands out to me is the total expense ratio is just 0.04%. Now, generally speaking, anything below, I would say 0.1% is a relatively cheap expense ratio, but 0.04% is one of the cheapest expense ratios across any ETF in the market. Which means for long-term investors like myself, holding onto this ETF long-term will not cut into too much of the profits later on. Now, it then says that the objective of the ETF is that the fund's goal is to track as closely as possible, before fees and expenses, the total return of the Dow Jones US Large Cap Growth Total Stock Market Index. Some more facts about the fund: the inception date was 12/11/2009. The fund is a passively managed fund, and the assets under management, the total assets, is over $18 billion. This ETF is up 469% And that is just in the last 12 or 13 years. In the last 10 years, this fund is up 261%. And as we go through these different time frames, you can see exactly how much this fund has returned on an annualized basis. On the 5-year time frame, 83.31% return. Now the 1-year time frame has been a little bit rougher because of course the drops that we saw in 2022 into 2023. But year to date, this fund is up 32.29%. And that's even after the recent small drop off where SCHG was trading at $78 per share just a few weeks back. Now just to give some more context, the S&P 500 index, one of the most popular investments for pretty much any long-term investor, year to date has seen a 14.27% return, which generally speaking is very, very good. But once again, looking at the Schwab US Large Cap Growth ETF's year-to-date return, it's not even comparable. Now digging into the exact reason on why this ETF has performed so well over the past 10 plus years, and definitely so well year to date. It's of course because of the holding breakdown. Now this ETF has around 45% technology, which gives this ETF a higher beta than other ETFs out there, but if and when the market does turn bullish, technology stocks in general have a tendency to really move up in price very quickly, which is definitely partially how this ETF has seen so much massive amounts of return over the past 10 plus years. Now the next biggest category is healthcare at 13.8%, communication at 12.8%, consumer cyclical at 12.1%. Financials at just over 6%, industrials at 3%, consumer defensive at 1.8%, basic material at 1.8%, energy at 1.5%, real estate at 1.1%, and utilities and cash under 1%. Now when I show you the top holdings in this ETF, it's going to be very obvious on why this ETF has performed so well and why, in my opinion, of course I could be wrong, but in my opinion, why this ETF is going to continue to perform well long into the future. The top 10 holdings being Apple, Microsoft, Amazon, Nvidia, Alphabet, Meta, Tesla, United Health Group, and Eli Lilly. Now, of course, because SCHG does track the Dow large cap, there are going to be 245 different holdings in this ETF, which makes the ETF pretty well diversified, which for the most part doesn't really matter all that much when the top 10 holdings are companies like these, which once again, when the market turns bullish, these companies in general perform or have performed very, very well. Now the Schwab US Large Cap Growth ETF does pay a very small dividend. And although the dividend score is honestly pretty bad considering the trailing 12-month dividend yield is 0.46%, the trailing 12-month dividend growth rate has actually dropped. And the 10-year dividend growth rate being 2.6%, which is much lower than what pretty much any dividend growth investor is looking for. The fact of the matter is that investors buy into this ETF because they want to see some growth. They want to see their portfolio grow in a relatively short amount of time very, very quickly. And for the most part, other than a few times in history during massive macro events, that's exactly what this ETF has been able to do. Now, generally speaking, when it comes to investing, younger people should consider taking bigger risks for several different compelling reasons. And of course, while risk tolerance varies from person to person, here are some of the key arguments for why those in their 20s should be willing to embrace risk in their investment strategy. Now, number one being time horizon. One of the most significant advantages young investors have over older investors is they have time on their side. Especially if you're in your 20s, you typically have several decades ahead of you before you even need to access any of the funds within the investment to use for things like life expenses or even retirement, of course. And because of this long time horizon allows you to ride out the inevitable market fluctuations and recover from any downturns that might happen from now till then. Number two is compound interest. Albert Einstein once called compound interest the eighth wonder of the world. Compound interest allows your investment to earn interest on both the principal amount and any previously earned interest. The longer your money is invested, the more the power of this compounding effect becomes real. Riskier investments may have higher growth potential, which when compounded over time can lead to substantial wealth accumulation. And lastly, number three, the ability to recover from your losses. Young investors have the luxury of time to recover from investment losses. So even if you were to make a risky investment that doesn't perform well initially, you have years or maybe decades to adjust your strategy, recover from those losses, and then hopefully see massive future gains ahead. So if you are currently in your 20s and have a long time frame ahead of you, investing into something like SCHG with a basket of stocks that definitely have massive growth potential, and of course looking at the historical performance the ETF has offered so far, could definitely allow a younger investor to see massive compounding returns long into the future. But it's also important to note, especially for newer investors, to do your own research, build a strategy that works for you, and of course, maybe most importantly, investing is a long-term game, but getting started early can definitely help. If you enjoyed this video, make sure to please drop a like on it and subscribe for more content like this in the future. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here. With inflation skyrocketing and everyday living becoming more and more expensive, one of the biggest things long-term investors like myself should be focusing on is how they are going to generate more and more cash flow over time from investments as time goes on. Now, this is very important and maybe the only fighting chance we have to fight back against how expensive life has become, and most likely how expensive it's going to be in the future, unless you for whatever reason think that things are going to get much cheaper from here, which I doubt a lot of you do. Now, in this video, we're going to be breaking down which metric I think is very, very important that a lot of long-term investors might be overlooking, but should be focusing on particularly when it comes to investing. Then we're also going to be going over a perfect investment vehicle that is not only going to keep up with inflation, but could even surpass it in the future. Now stick around, drop a like down below, and let's get right into it. Now first, before we dig a little bit deeper into this metric and of course which ETF can offer a fighting chance against inflation and all other future expenses increasing over time, let's look into the United States inflation rate. Now if we look at the inflation rate on the 10-year time frame, we can see very specifically that of course over the last few years inflation has absolutely skyrocketed, but even before then inflation has consistently been going up more or less over the last 5 to 10 years. Now, a lot of investors, including myself, don't think that things are going to get much cheaper anytime soon, and in my opinion, things are probably only going to get more expensive as time goes on, but we can of course discuss that in a different video. But regardless, even if inflation was to stay at, let's say, 2 or 3% on a yearly basis, that's still going to be a significant increase in expenses when you extrapolate out 10 or 20 or 30 years from now. So again, this is more geared towards younger investors that have a long time frame ahead of them. Not to mention things like median sales prices for houses across the board. Looking at how much the average house has cost over time is also a very clear indication that inflation is here and that things most likely are going to keep getting more and more expensive. Once again, unless you think for whatever reason that house prices are going to get chopped in half, which of course is possible, but in my opinion, not very realistic. Now, the metric I'm talking about is DGR, or dividend growth rate. So dividend growth rate is a measure that indicates the annual rate at which a company's dividend payments have increased over a specific period of time. It represents the compounded annual growth rate, or CAGR, C-A-G-R, of dividends over that period. And the dividend growth rate is often expressed as a percentage. Now, if you were to calculate the dividend growth rate, you would typically take the difference between the final dividend payment and the initial dividend payment, divide it by the initial dividend payment, and then divide that result by the number of years in the period. And finally, the result is expressed as a percentage. So a real quick example of this would be, let's say a company paid a dividend of $2 per share in the first year and then increased it to $2.50 per share in the 5th year. The dividend growth rate over a 5-year period would be calculated as follows. It would be the final dividend minus the initial dividend, divided by initial dividend, divided by number of years, which would give us in that circumstance a 5% dividend growth rate. Now, dividend growth is especially important for investors that might not have all that much money, all that much capital to invest into an ETF like this. Now, this is simply because in theory, what this means is that if an investor was to invest into something like SCHD today, which is paying out a current dividend of around $2.80 or so as of 2023, if SCHD ETF's dividend growth rate continues like it has in the past, that investor will be getting paid more and more money for every single share of SCHD that they own. And it's probably not even worth explaining why that's an important metric, because as we just saw a second ago, all the different inflation data shows very clearly that either your income or your investment income needs to stay on pace and keep moving up over time. And a best case scenario would be both your income and investment income, of course. And although of course there's many different options to invest into that do offer a nice healthy dividend growth rate, one of my favorite ETFs, one of the largest ETFs across my portfolio, is the Schwab US Dividend Equity ETF, which does offer a massive dividend growth rate, which we're going to go through here in a second. Now, real quick, if you're not aware, the SCHD ETF or the Schwab US Dividend Equity ETF offers a very cheap expense ratio of just 0.06%, which means over time the fund's expense isn't going to eat up too much of your profits. Now, also important, this fund tracks as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index, which is a very impressive index which has a lot of screenings for stocks to get in and out of, which makes the overall list of holdings pretty impressive. But to get right down into it, because we're really focusing on the dividend growth rate that an ETF like the SHD ETF has, and how this can not only keep up with but even surpass the inflation rate that we could possibly see long into the future. Once again, this is just assuming that things are going to continue to get more and more expensive, which happens to be my point of view. Now, SCHD has a dividend growth rate of 5.7% over the last trailing 12 months, but on the 3-year time frame, 11.44%. On the 5-year time frame, 13.69%, and on the 10-year time frame, 11.11%. So regardless on whichever time frame you look at, more or less, the SCHD ETF has continued to pay more and more in dividends year after year for the most part, every single year since this ETF's inception. Now, even if you were to downplay the dividend growth rate that SCHD has had so far, even if you were to say the dividends paid by SCHD are going to be moving forward, let's say 5 to 7 to 8% on a yearly basis, that means that on a yearly basis, you are going to get a raise in the form of quarterly paid dividends of say 6, 7, or 8% every single year ongoingly, which is going to easily keep up with the rate of inflation if inflation stays around say 2 or 4% on a yearly basis. One of the ways that I like to compare dividend growth to is considering dividend growth like a job. Every few years you might get a raise. Some years you might get a bigger raise. Some years you might get a little bit smaller raise. But the longer you stay at the job, in theory, the more raises and the more money you should earn in the future. And what's cool about investing, especially into a fund like SCHD, is that once you're invested into the ETF, there's no work. It's not like a job where you have to go there, clock in. You just buy into the fund, and at least historically speaking, it pays you more and more and more year after year. Now, this is exactly one of the main reasons on why I use SCHD as a main foundation for my overall long-term portfolio. I'm currently 31 years old, and I've been buying shares of SCHD consistently over the last few years, and I'm going to continue to load up on shares, not only, of course, because of the healthy dividend growth rate and the fact that I want to have an investment that's going to continue to pay more and more to not only keep up with the beat inflation, but also, of course, the fact that SCHD does have some massive growth potential as far as ETF price, and also important to mention the fact that SCHD has a good screening process for different holdings to become a part of the index. But like I said a second ago, it's not only SCHD that has a great healthy dividend growth rate. Looking at something like the Vanguard Dividend Appreciation Index, or ticker symbol VIG, this is another one of my favorite long-term buy and hold ETFs that has a considerably high dividend growth rate. Used, for example, back in 2013, VIG was paying 40 cents per share per quarter, and now just as of recently, almost 80 cents per share per quarter in dividends, which means the dividend was almost doubled over the last 10 years, which is very, very impressive. And to be completely honest, there's lots of different investments that can keep up or surpass the rate of inflation, but I think that dividend growth rate is an important metric for a long-term investor to not only keep an eye on, but also to really utilize for their overall strategy when it comes to investing long-term, because I would hate for this chart right here, the United States inflation rate chart, to be outperforming your overall growth in your investments long-term, because at that point you're pretty much just spinning the wheels. But when it comes to holding on to a long-term buy and hold ETF that you think is going to surpass the United States inflation rate long-term, comment down below some of the ticker symbols in the comments and let us know which one's your favorite and why. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here. Now, when it comes to investing in the stock market, there's going to be various risks depending on whether you buy into different ETFs, different stocks, etc. But in this video, we are going to go through a risk-free method on how any investor like you or I can receive a massive amount of yield on a yearly basis for literally no risk at all. Now, before we get into that, I wanted to mention that risk isn't always a bad thing. If you would have bought into the S&P 500 over multiple different time frames, for example, when it seemed like it might be the riskiest thing of all to invest into, times when the S&P 500 was down 10, 20, or 30%, let's say. If you would have bought into the S&P 500 even the entire way down and then just held on to the S&P 500 over a span of say 5 or 10 years, all that risk would have paid off and you would most likely be very, very happy with your returns. But for the investors like myself that might have some idle money sitting on the sidelines that they are not willing to risk at all, well, this could be the perfect situation to do so because low risk or no risk fixed income options are now available, offering massive amounts of yields because of the fact that the interest rates are still so high. You see, the higher and higher that interest rates go, the higher and higher that fixed income yields go, which means that for investors interested in buying into things like CDs or certificate deposits or even US Treasury bonds, there is a ton of yield to be made as of right now. For this video specifically, we are going to be looking at different CDs, and these CDs specifically are on the Fidelity platform, which we're going to look into, but also you can go to bankrate.com or just Google top paying CDs, and there's tons of different banks and brokers that are offering a ton amount of APY as of right now due to interest rates skyrocketing. So first, maybe let's talk a little bit more about why even invest into something like a CD through a brokerage. Now, brokered CDs are pretty nice because if you already have a stock market portfolio per se on the Fidelity platform or TD Ameritrade or any of the other brokers, you can normally buy brokered CDs right through the platform and it keeps everything nice, neat, and all together. But when it comes to CDs, as of right now, you are going to see different amounts of interest being offered on different time frames, and this has a lot to do with whether or whether or not interest rates are going to remain sustained higher for longer or move down in the future. Now, for example, when it comes to CDs, for 3 months till maturity, right now a 5.45% is the highest amount of interest being offered. On the 6-month maturity, 5.45% also. But if you go out 9 months, if you have your money locked into a CD for a little bit longer, you're looking at 5.6%, and even 1 year, 5.7%. Now, for most investors out there, we'd be pretty happy with, say, 6, 7, 8, 9, 10% return per year. But of course, that's going to come along with some risk. And like we showed earlier on the S&P 500, there's going to be multiple different time frames where you might be in the deep red when it comes to the stock markets. So CDs come in pretty handy because you are not going to be in the red when it comes to a CD. You're buying into this fixed income and you are going to get paid a set amount of interest, regardless of what happens in the stock market during the duration of your CD. Now, even a little bit further out maturities, 2-year, 3-year, 5-year, and 10 years, these are between 5.5 and 5.6%. But just for this video's sake, let's look into this brokered CD at 5.7% and see what it looks like. So once again, this is inside the Fidelity platform, but pretty much all brokerages are going to have something very similar. So it says right here, as of right now, the JP Chase is offering a 5.7% CD, which is going to pay out at maturity. The maturity date is around a year from now. It is not a fractional CD. The yield is 5.7%. And with this specific CD, there is not going to be any call protection. Now, call protection basically just means that the issuer, in this case, JP Morgan, is going to actually be able to call the CD early. A lot of times it's like 3 or 4 months away from when you open the CD. So in that case, you are going to be at risk of having your CD called away early. But in my view, I don't really have a problem with that because if JP Morgan wants to hold on to my money for a few months, pay me a 5.7% and then give me back my money plus the interest at any time in the future, I'm perfectly fine with that. Now, to give another example of what some other CD websites look like, this is right here on Bankrate, and it shows pretty much all the same stuff. It shows different offers from different banks offering different terms. This right here is 1 year, and you can set the terms to whatever you want, and you can sort of course by highest to lowest yield. Now, it's always important to make sure that the CD is a member FDIC because you are going to have some insurance, of course, within a certain amount of money if, for whatever chance, the bank or the CD issuer does go out of business within the time frame that you're holding onto the CD. But for the most part, in my opinion, as long as you stick with some of the bigger, more well-known, well-capitalized banks, in my opinion, you should probably be fine. Now, that being said, sometimes some of these more random or local banks will offer a higher APY. Like take this, for example, CFG Community Bank is offering a little bit higher yield than some of the others. And in my opinion, that's because you are taking on a little more risk when you are banking with something a little bit smaller. I'm not saying that CFG Community Bank isn't well capitalized. I have no clue what this bank even is. I'm just saying that for me personally, I like to stick with Bank of America or Chase when it comes to CDs for the most part. Now, a lot of you are probably asking, well, why is it worth investing into a CD, even if you're going to earn a 5 or 6%, when you could just buy into the S&P 500, and if history was to repeat itself, you'd be able to outperform the CD by quite a lot. And I would say to them, in short, that's a really good point. And for me personally, again, everyone has their own investing strategy and their own risk tolerance. But for me personally, I only utilize fixed income like treasury bonds or CDs when I do have capital, when I do have money on the sidelines that I'm not really planning on investing. Now, that being said, I always like to keep some of my money liquid and have some cash balance for red days when I do want to add long-term positions to my stock portfolios. But let's just say, for example, you just sold a property or you just came into some sort of liquidity event. And let's say you had 20, 30, 40, 50,000 or maybe even more sitting on the sidelines that you weren't really in a rush to invest into the stock market or a rush to invest into the next investment that you're looking to invest into. In that aspect, I do think that some of these options as of right now, like CDs, even the 1 year or even a little bit shorter duration, or even things like the 3-month treasury bonds or something that I've been utilizing, it's an easy way to get a risk-free 5.5 roughly % without much thought of all. So like I said, when it comes to fixed income and risk-free investments like CDs or like some of the treasury bonds that we didn't actually go through in this video, but we will be going through these in another video, so make sure to please subscribe for that. I do think these investment vehicles do have a very specific use case, but as the rates have continued to skyrocket, they're becoming more and more appealing even for younger investors like myself that just have some money on the sidelines. Now lastly, I'll also mention that when it comes to investing or buying CDs, I personally purchase CDs inside brokerages like Fidelity and like TD Ameritrade, and I've also purchased CDs right through banks, through their websites and other things. And take it from someone that's done it both ways, I definitely encourage everyone to look into brokered CDs because it is much easier. It's really as simple as logging into your brokerage, clicking on whatever maturity time frame you want to look at, and then right there seeing all the different banks, all the different offerings, then just clicking buy as many of them or as little of them as you want, and it's really just as easy as that. Also, what's great about doing it right through the brokerage is whenever the CD is matured, you just get paid out all your principal plus all the interest right back into your brokerage, which of course then you can use the money to invest in stocks, ETFs, or of course you could even buy more CDs. And for me personally, as of right now, I do think that interest rates are going to go down a little bit at least in the next 12 months. So I've just been buying into things like the 3-month to 1-year time frame CDs just with some cash that I have on the side. Once again, not by any means my entire portfolio, but just with some side cash, and it's worked out pretty well for me so far. But when it comes to buying into risk-free fixed income options like CDs or even like US Treasury bonds, I want to hear from you guys down below. Are these currently something that you're utilizing for your overall investment strategy? And if so, let us know down below. Is it US Treasuries? Is it CDs? Let us know in the comments. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here. This video is perfect for any dividend growth focused investors out there that are interested in investing into high quality dividend growth ETFs that offer things like diversification, growth, and dividends that only get bigger and bigger over time. Now, the 3 ETFs that we are going to break down in this video are going to be the SCHD ETF, DGRO, and one of my new favorites, DGRW. Now, to be honest with you, all 3 of these ETFs are extremely solid in my opinion, but there's only going to be one winner, which you are going to see towards the end of the video. Now drop a like down below, subscribe, and let's get right into it. Now the first dividend growth ETF that we're going to break down out of the 3 is going to be the Schwab US Dividend Equity ETF known as SCHD. Now this ETF's objective is pretty simple. It says the fund's goal is to track as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index. And some of the highlights of the ETF: a straightforward low-cost fund offering potential tax efficiency. The fund can serve as part of the core or complement a diversified portfolio. Now SCHD tracks an index focused on quality and sustainability of dividends, and we're going to break down the holdings within all these ETFs in just a minute here. Now this ETF has performed very well historically over the last 12 or so years. It's up around 171% as far as just ETF price return. But over the last year or so, especially year to date, this ETF has been feeling some pain, down around 5 or 6%. Now looking a little bit deeper into the holding breakdowns for SCHD, this ETF is mostly made up of industrials at 17.7%, then healthcare, financials, consumer defensive, and technology. And the holding breakdown, of course, is going to be a very important aspect of any ETF that you invest into, because at the end of the day, this is exactly what you're getting exposure to. You're buying into an ETF to get exposure to the holdings within it. Next, SCHD has a smaller portion of energy, consumer cyclical, communication, basic material, and utility. Now the top 10 holdings as of right now for SCHD is Amgen, AbbVie, Chevron, Merck, PepsiCo, Coca-Cola, Verizon, Texas Instrument, Broadcom, and Pfizer. And all in all, there's around 100 different holdings within this ETF. And all these holdings have a few things in common. They all pay dividends, they're all solid stocks of their own, and they all have a history of raising dividends over time. Now the expense ratio for SCHD, another important aspect of any ETF that you're going to invest into, is just 0.06%, which makes this ETF very affordable to hold on to. Now lastly, looking at another important metric when it comes to SCHD, dividend yield. The trailing 12-month dividend yield is around 3.69%, but also very important, SCHD does have some massive dividend growth. Over the last 3 years, 11.4% is the dividend growth rate on the 3-year CAGR. Now the 5 year is 13.69% and the 10-year is 11.11%. So when it comes to this ETF, you're not only getting a nice initial basket of holdings, a nice starting forward dividend yield, but also some massive dividend growth, potentially ahead. But now seeing exactly what DGRO, the next dividend growth ETF, has to offer, and to see if it's better or worse than that of SCHD. So DGRO offers low cost exposure to US stocks focused on dividend growth. which is one of my favorite aspects of dividend investing in general. Number 2, it says access companies that have a history of sustained dividend growth and that are broadly diversified across industries. Sounds pretty good so far. Now, DGRO on the max time frame is up around 98%, which is pretty impressive. Also, the DGRO ETF is beating the SHD year to date, only down around 0.5% or so. Now, looking at the DGRO's breakdown of holdings, they have healthcare at almost 20% of the overall ETF. So I repeat, make sure you know exactly what holdings and what sectors make up the ETFs that you buy into, because that's what you're buying exposure to. The next biggest breakdown is financials at 18.5%, then technology, then industrials, consumer defensive, energy, utilities, consumer cyclical, basic material, and communications. Now, DGRO also has a nice solid basket of holdings and over 400 different holdings for DGRO, so it is going to be much more diversified compared to something like SEHG, which, to be honest, some investors like myself actually want more diversification than less. So the top holding of DGRO is currently ExxonMobil at over 3%, then JP Morgan, Microsoft, Johnson & Johnson, Apple, Chevron, AbbVie, Pfizer, Procter & Gamble, and the Home Depot. So a few of the same holdings as SHD, but overall a pretty solid makeup of top 10 holdings, if you ask me. Now, DGRO does have a little bit more of an expense ratio, so that's definitely going to be something to consider. Although at just 0.08%, the expense ratio is still relatively very cheap. Now, DGRO is going to have a 2.56% trailing 12-month dividend yield, which isn't all that bad at all, but the dividend growth for DGRO has been very, very impressive year to date, up over 12%, the last 3 years 8.7%, and the last 5 years over 9%. So DGRO's strategy is to buy into different companies that have a history of growing their dividends, and that's exactly what they've been doing and able to do so far. The last ETF that we're going to go through in the battle of dividend growth ETFs, trying to figure out which one is best, is DGRW, the Wisdom Tree US Quality Dividend Growth Fund. Now it says, why DGRW? Gain access to the current investment landscape of US large cap dividend growing companies by applying quality and growth screens, and use as a complement to high yielding dividend strategies or replacement for large cap quality strategies. Now, DGRW came across my radar as of recently, and I've definitely been interested into it, and you're going to see why in a second. Now, DGRW over the past 10 or 11 years is up around 157%, not even including dividends, and year to date is the only one that's green out of the bunch, up over 5%, which is pretty impressive compared to the others. Now, DGRW is going to have technology at the biggest portion of their entire ETF at almost 30%. So that means that this ETF compared to the other two is going to have a little bit higher beta, which means that when the market goes green, DGRW is going to move a little bit faster with it, and vice versa when the market goes red. But with technology being almost 30%, then consumer defensive is next, industrials, healthcare, financials, consumer cyclical, basic material, real estate, energy, utilities, and communication. Overall, I really like the sector breakdown, and this is one of the main reasons on why this ETF is really on my radar. Now, the top 10 holdings for DGRW are very, very solid companies. Companies like Microsoft being over 8% of the entire ETF. Then we have Apple, which of course we all love. Johnson & Johnson, Broadcom, Procter & Gamble, the Home Depot, Merck, Cisco, Coca-Cola, and Walmart. Now, DGRW is also, I would say, very diversified with just about 300 different holdings within the ETF. So far, this ETF seems really, really solid. Now, one of the negatives for sure when it comes to DGRW is the expense ratio at 0.28%, which is much, much more expensive than that of DGRO and SEHD put together times 2. And looking at DGRW's dividend, they're offering around a 1.92% trailing 12 month dividend yield with some dividend growth historically. Looking at the dividends over the past, say, 10 or 12 years, you can see that there has been some significant dividend growth over multiple different time frames. So now that we went through all three of these different super powerful high quality dividend growth ETFs, that honestly I am a fan of every single one of them. There's only one thing left to do, to stack up DGRW next to DGRO, next to the SHG ETF, and look at how they've all performed over multiple different time frames using total return as the metric. So total return is dividends plus price return included. And although moving forward, I think pretty much any of these dividend growth ETFs could be an awesome investment for a long-term investor, this is going to show us exactly which ETF is a true winner. So over the last 6 months, DGRW is the winner at 4.65% total return, then DGRO at 2%, and SHG is basically flat. Year to date, DGRW is crushing both DGRO and SHG. DGRW almost 7% in the green, DGRO 1.25% in the green, and the SHG ETF minus 3.35%. Now, over the last 365 days, 18.3% DGRO, 14.07%, and the SHD ETF 9.07%. So honestly, all three of these did pretty well over the last 365 days, relatively speaking, but DGRW is still the winner. Now in the 3-year time frame, this is where things change. SCHD is the winner at 42.45%. Next is DGRW, and last is DGRO. So a little bit more stretched out, 3 years, 1,095 days, the SCHD ETF pulls ahead and wins. Now over the last 5 years, the longest time frame that we have to go off for here, the DGRW ETF has a 58.93% return, making it the all-out winner. And the DGRW ETF has won on multiple different time frames. Number 2, right behind it by sliver, is the SCHD ETF at 57.66%, and then DGRO at 50.31%. So even though, as you can see from the chart, they all trade pretty close to each other over multiple different time frames, just as of recently, maybe just as of the last 6 months or so, the DGRW ETF has officially pulled ahead to make it the official winner out of these three. So there we have it. Those are 3 of maybe what I think are the highest quality dividend growth ETFs across the entire market. But now I want to hear from you guys down below if you could only hold on to either DGRW, DGRO, or SHD forever. Which ETF would you hold on to and why? Comment down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this.